Well, greetings to all my investment clients. My name is Walter Measers, your wealth manager and CPA tax advisor. Before I get into the details of our weekly stock market recap as of June 6, 2025, please read this disclosure statement. You may want to pause this video to read the full disclosure statement. And also, if you want to find out more detailed information about Trinity Wealth Solutions and myself, you can go right here to this website, brokercheck.finra.org. Today I want to start off with pretty much the jobs report, payroll report, which was reported today, meaning June 6th, 2025, for May of 2025. The U.S. payroll, non-farm payrolls increased by 139,000, exceeding expectations of 126,000. The unemployment rate held steady at 4.2%, and average hourly earnings rose 0.4% over the month, exceeding the expected 0.3% rise. So these numbers, again, the market took it as suggested a resilient labor market. So the market reacted positively to these numbers. The dirty little secret, unfortunately, that's not really talked about quite a bit is revisions, meaning payroll revisions. So in this last report, it was also reported that previous month's April jobs report was revised down, indicating that the economy added 147,000 jobs, not 177,000. And these revisions over the last, I think, year and a half are pretty significant. So right here, the Bureau of Labor Statistics, they report this. It revises monthly job report estimates to refine the data based on more complete information. The initial estimates, right here, published approximately 3 weeks after the reference period, are revised twice before becoming final. But what's interesting, the revisions can significantly impact reported job growth, as seen in the recent downward revision that showed the economy added 818,000 fewer jobs than initially estimated. Now, Wall Street doesn't talk about this. A lot of economists don't talk about these revisions. I don't know. I'm baffled. That's a significant number. So what it really shows that the job market is not as resilient as the headlines say. When you revise 818,000 over the last year and a half, that's pretty significant. Again, but nobody goes back and really reports that in the mainstream financial media. That's the unfortunate part. So what I'm getting at is, when you start adding all these indicators, the economy is definitely slowing down. Are we at a recession? Technically, no, but everything is slowing down. So that doesn't indicate, a guaranteed recession, but definitely it's trending in that direction. And what does that mean to the stock market? At some point, the stock market is going to come to the realization that, hey, we've overshot here. The fundamentals of the economy are not looking good. So let's get into the stock market. So if we looking at the wrong chart, sorry. If we look at Friday, meaning June 6th, the market reacted on news. Again, the market lately has been very news driven. So for Friday, the markets were up. Let's just call them, 1% up. S&P 500 and QQQ, a little QQ by 1.1%. Why did the market go up? Really two things: the jobs report, and then in the morning, I believe Trump announced that potentially there's a deal to be signed with China. Nobody knows the details, meaning the tariffs, tariff deal. That propelled the market to higher. So, can you really trust the market when it's that news driven? A couple of weeks back when it looked like the China deal talks were kind of on hold. The market didn't like that. So you have to be careful when markets are overreacting to short-term news. So again, one day the market liked what it heard in the news, so it trended up. But if we look at year to date, again, quick reminder, I'm comparing four kind of major asset classes: S&P 500, and gold, which is a completely different asset class, and then technology, QQQ, and long duration bonds. So for meaning year to date, the markets have recovered from this pullback back in April. And our clients actually are pretty much keeping up with the stock market with less risk, because we missed this downturn right here. Remember, we were out of the market February 28th, I believe, and then we got back into the market around May 8th, I believe. And we did take profits as the markets continue to go up. We, I believe, May 5th took 30% out of the market, and then we still have 30% in the stock market. So 70% is in U.S. Treasury bills, 30% still exposure to the stock market. So if we look at 5 years, there was this pullback here in April. Now it's trending up. The concern that we have and the research we're getting, remember, short term, we're still kind of uptrend that the market could go up another 3-4% over the next 1 to 3 months. And then it could roll over significantly over the next 6 to 12 months. And why are we so concerned? Because this is, if we go back to 07, 09, markets were kind of trending, trying to find a direction. Here was 07 peak, then it went kind of drifted down, and then went back up, and went down, went back up. So in this stage 3, as we call it, you could have significant ups and downs, but at some point the market rolled over and had a significant pullback over 50%. And that's our fear. We think we are in stage 3, the topping stage, where the market really doesn't have that much more room to go up. So if we look at really a longer trend, as you can see, visually, the market's just been going up and up. Yep, you had some pullbacks, and that's what investors have been just kind of trained to do, or says, well, the market, they go down, but eventually, look, it goes back up. But at some point, this is going to roll over and continue to go down significantly. And that's what we're fearing, is that at some point, this may just roll over and pull back 30, 40, 50%. Again, I want to stress, there's no guarantees, there's no certainties, there's only probabilities in the stock market. But if somebody feels that this market is just going to continue forever without some major pullback, unfortunately, they're going to get hurt. They're going to get hurt in the market, because the mentality of buy the dip, buy the dip, buy the dip, that's been the mantra over the last 2-3 years. But at some point, that dip is going to turn into a major reset, and we're getting closer and closer. That's not my opinion. There's many research companies, technical analysts that are saying it's just a matter of time when this market is going to roll over. So that's what we're trying to do for our clients, is to minimize. And our target is that no client loses more than 6% in worst case scenario. We're trying to minimize that drawdown, that downturn. And that's the most important part of managing monies. And if you do that, you will accumulate more money. And it's really not trying to beat the market. So with that, hopefully you enjoyed the video, and wishing all of you a great weekend, super weekend spent with your family, relatives, kids. And stay tuned for next week, our weekly stock market recap. So take care and bye now.